The truth is, if you buy now, pay later, you better have the money to pay later. You may have heard of the company Affirm, which specializes in a buy now, pay later program. Now, they advertise minimal fees, no late charges, etc. Is it a good idea to buy now or pay later? In 2023, it was estimated that 84 million purchases, or almost 34%, were done with a buy now, pay later technique. Now, that same buy now, pay later payment would be about $1,100 compared to about $200 for that same purchase on your credit card. The truth is, if you buy now, pay later, you better have the money to pay later. Months prior, there was a high percentage that we would see a rate decrease as early as March. And now it's almost a foregone conclusion that rates will stay the same all the way until June, which now shows our highest probability of our first rate decrease, and that stands currently at 50%. We had been awaiting for this week's CPI, Consumer Price Index inflation report, and the numbers are in. And the good news is inflation continues its downward trend. The bad news? The expectations expected an even lower reduction in inflation than we actually got. So first, let's just look at the numbers. So our year-over-year inflation is now down to 3.1%, but expectations were they would be as low as 2.9%. So inflation's down, but not as low as we had hoped. Why does this change interest rates? Well, remember, first and foremost, rates are impacted by the secondary market and investors who are investing money in long-term mortgage bonds and mortgage-backed securities. When there's a fear of increased or higher inflation, these traders sell off, therefore devaluing those assets and causing interest rates to go higher. And even though inflation was actually lower, the headlines in the news cycles saying inflation was a miss was enough to spook traders and cause a massive reaction in trading right away and interest rates to go higher as a cause of it.